$120,000 income can trigger about $3,600 in Medicare charges. Do you know whether the levy and surcharge both apply to you? We will separate the two charges, run two pay packets, and close with the private insurance trap. First, the core distinction. The Medicare levy is normally calculated as a percentage of taxable income. The Medicare levy surcharge is an additional charge that may apply when your income for surcharge purposes is above the relevant threshold and you, your spouse, or dependents do not have the required private patient hospital cover. Similar names, different tests. Private health insurance does not usually erase the ordinary levy, and the low taxable income can reduce the levy even when you have no insurance at all. That separation is the first payoff. That is the split. Now, the ordinary levy. For most taxpayers, the headline rate is 2% of taxable income, subject to low income reductions and exemptions. If taxable income is $85,000 and the full rate applies, 2% is $1,700. It is part of the annual tax calculation, not a separate Medicare membership payment, and not the same thing as private health premiums. Your employer may withhold enough across the year, but the final amount is settled through the tax return. If this clears up a line you have seen on a notice of assessment, the like helps this reach the next confused taxpayer. That is the full rate example. Next, the low income ramp. The levy is not always a cliff where one extra dollar suddenly creates the full 2%. For 2025-26, an ordinary single taxpayer pays no levy at or below $28,011. From there, it phases in at 10 cents per extra dollar, capped by the ordinary 2% result. The upper point is $35,013. Different thresholds apply to families and people entitled to the seniors and pensioners tax offset. As at 29 July 2026, official 2026-27 ordinary low-income thresholds had not been published, so use the ATO calculator for the year you lodge. That is the low-income rule. Now, exemptions. Full or half exemptions can apply for qualifying periods under specific categories, including certain medical circumstances, foreign resident status, or not being entitled to Medicare benefits. Dependent circumstances can affect whether a medical exemption is full or half, and a Medicare entitlement statement may be required for a claim based on not being entitled to benefits. The annual answer can therefore be a day count, not simply yes or no. Do not copy someone else's exemption from a forum. Check the ATO category and keep evidence for every date claimed. If the facts are unusual, this is registered tax agent territory. We have the ordinary levy, now the surcharge. For 2026-27, a single person is in the zero rate base tier at $105,000 or less. Tier 1 is 1% from $105,001 to $123,000. Tier 2 is 1.25% to $164,000. Tier 3 is 1.5% above that. Family thresholds start at double those amounts, with adjustments for dependent children after the first. The income test can include fringe benefits, reportable super contributions, and net investment losses. Do you know whether the levy and surcharge both apply to you? Put yes, no, or not sure in the comments. That brings us back to the opening number. Assume a single Australian taxpayer has taxable income of $120,000. The full ordinary levy applies. Income for surcharge purposes is also $120,000. There are no dependents or exemptions, and there is no eligible hospital cover. The ordinary levy is 2%, $2,400. If the verified 1% surcharge tier applies, that adds $1,200. Total Medicare levy plus surcharge, about $3,600. This is an illustration, not a quote for your return. Save this example, then replace every assumption with your actual facts. That closes the worked example. Now the insurance trap. The surcharge test requires appropriate private patient hospital cover from a registered Australian insurer. Extras only cover for dental, optical, or physio does not count. The maximum permitted excess is $750 for a single policy or $1,500 for couples and families, and every required spouse or MLS dependent must be covered. Part year cover changes the surcharge day count rather than automatically clearing the year. Suspended cover does not protect the suspended days. Insurance can also cost more than the surcharge, so compare the policy, waiting periods, and value, not just the tax line. Share this with the person who thinks extras cover switches the surcharge off. The insurance trap is closed. Here is the practical check. 1. Calculate the ordinary levy from taxable income. Then test low-income reductions and exemptions. 2. Calculate income for surcharge purposes separately. Do not assume it equals taxable income. 3. Check whether every required family member had eligible hospital cover for the relevant days. 4. Compare the surcharge exposure with the real cost and value of cover without buying a policy from one tax number alone. Keep the statement, policy dates, and excess details. For a large or unusual result, use the ATO calculators or a registered tax agent. That is the machine. The ordinary Medicare levy is generally 2% of taxable income, with low-income rules and exemptions. The surcharge is separate. Different income, tiered rates, and an eligible hospital cover test. Private insurance does not normally remove the ordinary levy, and extras only cover does not solve the surcharge. General information only, not personal tax or insurance advice. Use current ATO guidance for the income year you are lodging. Subscribe for practical Australian money mechanics. Watch next. Private health insurance. when it actually saves tax, because the premium only makes sense beside the surcharge calculation.